Hello, Larry. Despite ongoing economic concerns, we've seen markets stabilize and even rally a bit. Can you help me characterize valuations as you see them right now?
In the case of credit, I would say that we've retraced probably about half of the losses that we saw between mid-February and early April. Spreads were about 470 basis points at an index level. Going back to February, they widened to about 570, so about 100 basis points of widening. And today we're just inside of 520, so maybe even a little bit more than half of that volatility has retraced. And I would say that the tone has clearly shifted negatively. Capital markets activity has become quite constrained again. But if I look at valuations in the secondary, the liquid loan market, we're pricing in a marginally higher level of risk than we were in February. But valuations have unfortunately been quite resilient. I would say there's really two reasons for that. One is fundamentals. We talked about this in our last update, that from an industry perspective, the leveraged finance market, whether you're talking public or private, is pretty well positioned. You don't have a lot of risk vis-a-vis input or revenues on these issuers. They're more domestically oriented. These loans, by and large, are senior secured first lien, so kind of like the mortgage on the house, and hopefully there's a meaningful level of equity in these businesses to absorb any of that negativity. And part of it is definitely technical. Periods where you've seen this really acute dislocation in the loan market historically, global financial crisis, COVID being two really good examples, that's typically been driven by deleveraging, forced selling versus just a fundamental repricing of risk. And there's not a lot of leverage in the market today in terms of, yields are pretty high, generally speaking. And so a lot of institutions are not using a lot of leverage to kind of hit their IRR bogey. So we've seen a much more orderly kind of movement in prices. And so what I would say is, this is not the tactical back the truck up moment for credit. Really, it's back to, you need to think about it as a longer term strategic allocation.
So on that point, for folks who might be concerned and have seen that there's a recovery in valuation, why is credit still an important part of an asset allocation?
I think today uncertainty is the word we clearly are using a lot. And I always think about with credit and with loans specifically that you have a much more finite set of variables than if I take versus equities as an example. And so you really have a more finite set of potential outcomes, I would argue. With credit, yield is going to drive the vast majority of your returns. That yield is made up of a base rate, which closely tracks the Fed funds rate and spreads. And clearly base rates can come down, but in our opinion at least, we don't think they're going to go to zero, but they could come down marginally. And if you do see the Fed lowering rates, that's likely going to be met with wider spreads. So I can come up with a reasonable set of expectations in terms of the range of yield I might earn on these assets over, let's say, the next few years. And then I need to net against that default losses. Even the best manager out there over a 3-year period is going to have default losses. And an economic recession would certainly raise expectations in terms of those losses. But I can clearly, again, come up with a range in terms of what does a worst case scenario look like in terms of default losses over the next few years, and then net that against my yield. And even in those scenarios, a fairly bearish set of assumptions gets you to, we think, an IRR that is potentially positive. And so, for investors who are looking to kind of understand assets a little bit better that will give them a more finite set of outcomes, credit certainly fits that bill. And for investors in credit, they can certainly work with managers to try to understand what should those expectations be. What are the portfolio managers seeing in terms of potential losses, and then try to back into what that return might look like. So in a day where uncertainty is very high, we think that loans actually offer a potential solution for some of that uncertainty.
Well, thanks very much for your thoughts today, Larry. I look forward to speaking to you next time.